Welcome to the Australian Property Podcast, helping you achieve success in property. Featuring your host, Jonathan Preston.
Hi guys, thanks very much for tuning back into the show. So in today's episode, I want to talk about the number of profit and loss-making sales in the September quarter for 2016. If you'd like to get in touch, send me an email at jp@australianpropertypodcast.com.au. Alright, let's get started. Alright, so to talk about some of the figures that I've got here, this is from the CoreLogic Pain and Gain report for the September quarter for 2016. Basically, this reports on the number of profitable sales for houses, that have been sold. Basically, it looks at, whether the owner basically made money from owning that property, and talks about the percentage of people that actually, were profitable in terms of the sale of their property. Now, while it's assumed that property in Australia only ever goes up, of course, that's not quite the case. Obviously, recent history indicates that that largely is the case when it comes to capital cities, and if you hold for a long enough time frame. However, not every single person who actually has a property, makes money on it. So to talk about these figures in a bit more detail, when you look at Sydney and Melbourne, figures obviously are very high. So in Sydney, the number of people that sold their property for a profit was 97.5%. So the vast majority of people sold for a profit. It's likely those that took a loss probably bought at an overinflated price, perhaps at an auction, and probably in recent times. Even if you paid a bit over the top and it was, let's say, 4 or 5 years ago, it's unlikely that you will have taken much or any of a loss if you were to turn around and sell now. You would have had to ridiculously overpay to lose against the growth that we've seen in the overall market over the last couple of years. But let's say you only bought, 9 months ago or something like that. You got way overheated and sold at auction, and then now you can't quite get to that same price. Well, then you'd potentially fall in that percentage of people that actually took a loss on the sale. Now, looking at Sydney's movement, you can see 97.5% basically made a profit. So the amount of people that sold for a loss is very minimal, but they exist. If we look at Melbourne, an even higher figure, 97.9% of people who sold their home actually made a profit on it. Looking at a few of the other markets, so Brisbane, 95.2%, Adelaide, 94.1%. What else have we got? We've got Hobart, 92.4%, Perth, 82.7%, and Darwin, 73.6%. Now, if we look at some of the regional markets, it does dip down a bit. For example, regional WA, 70.9%. So at that point, we're approaching nearly a third of people took a loss. You've got to consider as well that a lot of this, while I would say the people who actually lose money over time, they tend to be people that have held for a shorter time frame. But in terms of the average holding duration, I would say it is probably quite a few years. And so as a result, some people potentially bought maybe in the sort of mining boom times, and now they are unable to actually sell at a profit even if they have held for a couple of years. The worst performer overall was Mackay, which only had a 59.7% of profitable sales. So really, over 40% of people actually took a loss when they sold their property. So, that's a pretty substantial figure, I believe. It really is, nearly half of people who bought have taken a loss. And you've got to consider that a lot of the people that have actually sold have probably held their properties for a number of years. And so it's probably people that have held for 10, 20, 30 years, or probably at least 5 years in most cases, that have had the opportunity to actually make money and be in that 59% that have made money, but probably people that have held for a shorter duration, bought at the top of the market, or way overpaid at auction, or just way overpaid because they fell in love, in general. These would be the people that have really taken the hit here and basically, suffered a loss. These figures, I think that, they show that the strength, obviously, overall is in making, holding for a long term and being in a market that, is growing. If you were to compare this to the amount of profitable stock trades, I don't actually have that figure on hand, but having spent a lot of time in that area of the investment sort of markets and everything as well, I would say the amount of people that take a loss on stock investments would be significantly higher. It's probably 50% or give or take. If you were to look at this by comparison, if you're looking at Sydney and Melbourne, while this has been, I guess, an unusually strong period of growth, it is hard to dispute that figure is 97.5% and 97.9%. It really shows that, at least in recent history, while the market is growing very quickly right now, if you were to hold for a reasonable time horizon in a market that has growth potential and you don't ridiculously overpay, you should at least make money, even if these numbers were to fall dramatically. Let's say they were to go to 70, 80%. If you were to adjust it time-wise, let's say we fast forward 10 years from here. Let's say you bought today, even today being a super overheated market in these two regions particularly. Let's say you had to buy at auction, so perhaps you bought at a few percent above the median in that suburb. There's not a lot of supply. Whether you're going to make money in the next 2 to 5 years is a bit unsure. I'm not expecting a crash, but I wouldn't, be diving into buying a house, let's say in Melbourne, in one of these heated up suburbs, and expect that in 2 years I'm going to have a massive capital gain. You very well may, based on the momentum, but it's not something that I would be willing to bet on. It would be more a nice side benefit if that were to happen. But the reality is you would want to take a 10-year time horizon. Now, if we were to fast forward 10 years, I'm pretty confident you would not be selling that property for a loss. How much of a gain you're going to make, who knows? Let's say, I've been saying in recent times that you could really only expect capital growth of, let's say, 3 to 5% in most suburbs. And then you combine that with your rental yield of a couple of percent. So your actual return, let's say you look at a 4% growth rate, and let's say you're looking at a 3.5% yield, you're still getting 7.5% as a total return. It's really not that bad. You've got to look at where the cash rate is and everything at the moment. Even then, the rental yield exceeds what you would get having your money in cash in almost every case. Now, this obviously, there's a lot of debates we can have around this. We can talk about the cost of holding the property brings your net yield down. We can talk about 3.5% being too ambitious in a very fancy suburb, or can be way under what you would actually be willing to take if you're a professional investor and willing to go out further in terms of choosing a suburb in an area that yields higher. Maybe you have a benchmark of wanting at least 6-7%, or you're going to buy it 5 and 6%, and you're going to do a cheap reno to bring it to 7%. There's a lot of things we can talk about in this topic, but I'm using very generalized figures, and I say you've got to be realistic about your numbers. You can't expect to get rich overnight. That's not how this game works. It's not how any investment game works. And if you are going to be just a pure risk-based gambler that is going to leverage and hope for the best, well, look, good luck to you, and I really hope it works out, because I'm invested as well. But that's not the right way to play it. You've got to make a sound long-term investment in something that has some safety behind it, where there is ongoing demand, where you believe in the asset, where you can financially afford to hold it, where you have a significant time horizon, and where you are willing to ride out some volatility. And when you are sort of combining all those factors, you've got what I believe to be the successful recipe for making a successful investment. And if you were to acquire a number of properties that are predominantly land value based, in good commutable distances to major cities, where the economy is not doing too badly, then it would be hard to imagine that if you acquired a number of these assets and then held them for a 10, 20-year time horizon, that you would not end up fabulously wealthy. So I think that if you are inclined to property investment, which you probably are if you're listening to this, then basically if you can get a bit of capital behind you, you can make sure that you invest only in assets that aren't over leveraged, where you can afford to hold it, where the yield is decent or your earnings are so strong that you can afford to negatively gear it, and you've got a long enough time horizon, you believe in the investment, you're committed, and you don't need to access that money for a significant period of time, that I believe could form the substantial building blocks for wealth. Now, there's a lot of stuff that obviously I haven't discussed here, and you might want to refer back to my episode in terms of building a financial plan for yourself, because you've got to play a bit of defense as well. It's not all offense, but in terms of going on the offense and building wealth, I think that these figures today indicate that the money's there. Obviously, this is skewed toward market being so strong at the moment, but the odds really are in your favor in terms of making money, and it's just a matter of time, as long as you use your logic, don't go overboard, play the long game, and you know what you're doing. So I hope that helps. Really appreciate you listening today. Thank you very much. Thanks for listening to today's episode. Please subscribe to the podcast, and if you've enjoyed the show, I'd really appreciate it if you could leave a review on iTunes and recommend the show to any friends that you think might benefit. Thanks again for listening, and we hope to see you back soon.